That's great. So yeah, thank you very much for the kind invitation, Igor, for giving this webinar, right? This talk to share with like-minded scholars about some development that's happening here in Asia with regards to financial center development and also investment banking networks. So this is a project that I've been working on with a fellow colleague. His name is at the bottom of the slide, Dr. Kurtulus Gamici. He's from the Department of Sociology, where I am. So he's an economic sociologist who works very much with social network analysis. So it's one dimension where his expertise with network analysis really complements my own interest in financial center development and financial geography in that sense. So let me give a brief introduction about the nature of this project, as well as what I will talk about for the remainder of this session. So our interest really in trying to examine investment banks really comes from the observation that, obviously investment banks are highly globalized institutions, and they were very much in the news, of course, following the 2008 global financial crisis. But our sort of interest in it and the imperative, the rationale for wanting to look more closely at investment banking activities is the idea that rather than looking at investment banks only as highly globalized institutions, we want to examine the territorial dimensions of these firms and to look at the ways in which particularly local and regional geographies may shape their business activities and their relationships, such that you get very distinctive types of ecologies and networks in different financial centers. So in trying to examine investment banks in particular, then, and as well as law firms, I'll speak a little bit about the interest there and how they shape global production structures and strategies. We focus in particular on two business segments of investment banks. One is on mergers and acquisitions, M&A, and the second dimension on equity capital markets, ECM, because these are two core segments of businesses for investment banks, and they also have direct implications on the business strategies and production networks of other firms, particularly production and manufacturing firms. So our interest really is on trying to examine how these firms, as investment banks, how do they interact with and negotiate with local and regional actors, and in what kind of context in different international financial centers. So this concern really came out of a project that I was working on with a couple of other colleagues, Neil Cole and Derek Wojcik, which we wrote about in a regional studies paper, where we wanted to call for looking at the territorial dimensions of global financial networks. So this next slide shows you one of the figures that we came up with in trying to talk about those conceptual ideas. The idea is that in much of economic geography, which is the field that I work in, there has been a lot of research looking at manufacturing, looking at firms in industrial districts, for instance, regional clusters, and the ways in which lead firms and their suppliers in interacting with finance and other business services are plugged into particular regions, right? Whether it's export processing zones, whether it's industrial districts, to create different kinds of development outcomes. But as financial geographers as well, we are particularly interested in looking at finance and advanced business services, which is the middle bit here, and the ways in which they connect with other kinds of territorial development, namely world cities or international financial centers on the one hand, as well as offshore jurisdictions on the other hand. So, but for quite a long time, these two strands have been studied very much in isolation. So we have economic geographers or firm or industrial geographers who study this middle bit, right, that looks at global production networks and regional development. And then we have financial geographers who look at finance and advanced business services like law firms, accounting firms, who look at their impacts on international financial centers and offshore jurisdiction. But clearly, they are very much interconnected in the sense that finance and business services are very much vital, right, in enabling global firms to get the right sort of financing, to plug into different types of financial flows in order to actually conduct or make certain kinds of business investments and decisions in different parts of the world through both world cities and offshore jurisdictions or tax havens. So this is very much, it came out of that kind of project to want to examine how finance intersect with production networks. So in essence, how finance and business services help firms to plug in to specific regions and territories, and in what ways. So this led us to embark on a project to look at the roles of investment banks in these sorts of production networks. So the wider project that I've been involved in the last 4 years now, coming up to 4 years, working with Dr. Kurtulus-Gamici, who's my collaborator on this project, looks at M&A as well as ECM transactions that has been recorded right through the Geologic database in tracking investment banking activities. The database records worldwide activities, although for the purpose of this particular paper that we were working on, we focused in particular on Asia financial centers. So the research took place in kind of 2 stages. So in the earliest stage, in stage 1, we were focused on investment banks themselves. So other than running network analysis using Geologic data on M&A and ECM transactions, we were also conducting interviews with investment bankers across different sites. So in key financial centers such as Singapore, Hong Kong, Guangzhou, Beijing, and Tokyo. So we conducted about 50 interviews over the course of about 8 or 9 months. And then stage 2, which is a bit more recent, over the last year across 2018, I got particularly interested in speaking to law firms as one of the key partners of investment banks in enabling these M&A and ECM transactions. So we became interested in looking at how key business partners like law firms are also vital in shaping those kinds of financial networks and production practices. So again, this was also followed by qualitative interviews with different law firms in Singapore, Hong Kong, Shanghai, and Beijing. And so far we've conducted about 30 interviews. So to get back to the topic of today's talk about investment banking networks in Asian financial centers, our query was driven by 2 key features of the literature. Firstly, is that there certainly has been a lot of studies on international financial centers, particularly the classic works that we know of about world cities and international financial centers as key nodes of command and control, and the need for co-location, right, in therefore encouraging agglomeration of these kinds of activities in particular kinds of world cities, and in order to reduce the risk through the building up of trust relationships. But the ways in which how these co-location strategies, how do they result in actual transactions? These were not, we found very little that has been written on tracing, right, the actual transaction that takes place within financial centers themselves, and whether such co-location strategies then relate to their positions of power within the industry networks in those financial centers. So there has been, therefore we argue that there's been limited research on the structure of financial networks within cities, and what that might reveal about these international financial centers as strategic places for specific types of financial firms. And the second dimension is that recent studies on world cities in particular have noted a distinctive shift from west to east over the past 2 decades, but especially since the global financial crisis from 2008 onwards, in terms of increasing network connectivity of certain key cities from emerging economies, especially the case for China and Chinese cities. The rising importance of Asia in global financial networks has also been noted, especially in terms of the growth of Japanese and Chinese investment banks, post 2008. So in that sense, our study of financial networks in Asia is an attempt to try to extend some of these preliminary observations with a more in-depth account that could help further develop our understanding of the geographies of finance in Asia. So in terms of studying investment banks within industry networks, we would argue that many studies on investment banks tend to focus on their firm size. So firm size in terms of, let's say, firm capitalization or the number of employees, or they focus on business value in terms of the size and value of business deals, the fees, revenue generated, for instance, as well as the international reach, right? For example, the number of headquarters or branch locations in different parts of the world. However, and this is of course a key argument from my economic sociologist colleague, from a sociological perspective, these measures do not really sufficiently capture the nature of relationships between investment banks and their different positions of power within the industry. So in taking a network approach then, we want to examine the power of investment banks in a network based on how resilient they are to the removal of other banks with whom they do transactions with. So therefore, the more deeply embedded a financial organization is within the network, the more central and powerful it would be within that industry. And therefore, in trying to study investment banks, of course, we wanted to clarify the different types of investment banks that are engaged in the industry. So, and certainly different types of investment banks have different strategies depending on the market segments that they serve. So we differentiate between bulge-bracket banks, middle market banks, and boutique investment banks. So bulge-bracket banks are the easiest to identify, and I think most of us would readily know which they are. These are industry leaders, whether you want to talk about deal value, firm size, or global networks. So bulge-bracket banks would be the likes of Goldman Sachs, Morgan Stanley, Credit Suisse, and so on, HSBC, Nomura. They work on the largest deals from transnational corporations, and they have the most recognized names in the investment banking world. Middle market banks work on slightly smaller deals, and often with a more regional focus. So for example, they may be focused more on North American deals or Asian activities or client networks. Or some middle market banks may also have industry specialization, for instance, focusing on agri-foods or on energy sectors. Boutique investment banks tend to be smaller in terms of having fewer employees with more highly localized presence, and they tend to be specialized in specific segments, such as they may specialize only in M&A, or they may specialize in particular industries, for instance, in healthcare. Although we do know of there are some boutique banks that are very specialized, but they also have very wide international networks as well. So in trying to look at investment banking activities, in this case, in ECM segments where there will be underwriters, right, in, let's say, an IPO offer, right, on a stock exchange, usually the investment banks would act as underwriters in such a deal, being led by a book runner or a lead manager, especially if there are a number of investment banks in a consortium in such a deal. So what we're looking for then is in these different ECM transactions, whether it's IPO listings or follow-on secondary listings, we identify the identities of investment banks in these kinds of underwriting networks. We look for repeated relationships, right, over time, and what they might tell us in terms of the power of different types of investment banks in these kinds of ECM networks. So this next figure kind of shows a very simplified version of what the relationship between different firms and actors might look like in an IPO deal, for instance. So for instance, we have a company that wants to issue shares on the stock exchange. The entire exercise will be coordinated, right, by one investment bank who may be identified as a lead manager, or sometimes they're called a book runner, who will coordinate activities amongst other underwriters, which will be other investment banks, as well as they will coordinate activities as well with a range of other firms, such as law firms, regulators, consultancy firms, auditing firms as well, depending on what the listing requirement is. And then each different underwriter, each different investment bank involved in this transaction will, through their own networks, offer connections, right, to potential investors, as well as offer sources of financing for the deal as well, because as underwriters, they will guarantee a particular volume of shares that will be bought or at a particular price, which is why they underwrite the deal in that sense, and that's why they have this underwriting role. But in such a relationship, right, in looking at this transaction, our key focus is on this book runner or lead manager role as the person, as the investment bank who is the leader in that sense in coordinating all these deals. So therefore, in trying to look at the investment banking networks of all these IPO issues or ECM transactions, what we're trying to offer is a structural analysis on the power of investment banks, which we hope would explain their network positions, right, in different financial centers in Asia. And the three financial centers that we have chosen to focus on are Japan, Hong Kong, and Singapore, for the key reasons that these are the three kind of biggest and most vibrant stock exchanges, locations of stock exchanges in Asia, and they're also the leading financial hubs in Asia as well. So before I go into the actual analysis, I also want to give some of the contextual as well as regulatory backgrounds of these three financial centers, which will help us in interpreting some of the findings that we encounter later on. So if you look at Japan as the first case, in terms of its banking industry, it has a highly segmented banking industry in the sense that the different banks are grouped according to whether they are city banks, trust banks, regional banks, credit cooperatives, and so on. But a lot of these banks are also held together by cross-holding relationships or long-term relationships with one another. So it tends to be a very cohesive, right, type of a structure. So there has certainly been a lot of very substantive reforms in the banking sector, particularly following the 1997 Asian financial crisis. So at that point, it was called the Big Bang reforms in Asia. And what emerged out of these reforms is that it led to a wave of mergers and acquisitions amongst the banks themselves. There was considerable industry consolidation. And out of that Big Bang reforms, we have the emergence of Japanese mega banks that we know today. So huge banks like Mitsubishi Group, Mizuho, Sumitomo, for instance. So the banking industry in Japan is highly concentrated. So as noted by other scholars, more than 70% of equity underwriting in Japan is conducted by just three firms, Nomura, Mitsubishi, and Daiwa. So highly concentrated in the hands of a few big investment banks. So the barriers to foreign investment banking firms in Japan clearly is that it is very difficult to compete against these very entrenched distribution networks, right, of these Japanese banks. So a lot of the domestic issues, in particular by domestic companies, will already be handled by these Japanese mega banks. But bulge-bracket investment banks do have a niche role, particularly when we're looking at global issues that require, right, the kinds of global distribution networks that bulge-bracket banks do have. So I'll speak a bit more on these niche role of bulge-bracket banks in Japan a bit later on. But this highly concentrated characteristic of Japanese mega banks is something to keep in mind for the Japanese case. Now in Hong Kong presents quite a sharp contrast, unsurprisingly. So it has a much more liberalized banking environment, very much tied to its historical role as an entrepot, a trading port since colonial days. So Hong Kong used to have a monolithic system, so a single tier licensing. So it does not differentiate between different types of banking activities or different types of banks. So there's only one type of banking license. So under that kind of a licensing environment, both local and foreign banks could operate very freely, depending on whether they want to identify different types of banking products and services or niche markets that would best suit their capabilities or business strategy. So even though later on, a three-tier banking system was introduced, right? There's segments so that banks could apply for different types of banking licenses with different responsibilities as well as different privileges. But the result was that there was actually very limited change to industry structure because of the early presence of many of these large foreign banks and the historical network. So there was just no incentive for them to change to a different tier of licensing. So many of the large foreign banks still occupy the top tier of licensed banks with a full range of banking activities. So what we have seen then, unsurprisingly, is that Hong Kong serves as a very important gateway for capital flows going into and then later on out of mainland China as well, especially after 1997. So a key factor in trying to interpret the ECM market in Hong Kong is the large numbers of Chinese companies that have their IPOs or secondary listings on the Hong Kong exchange. So if we think about mainland Chinese companies who are seeking IPOs or secondary listings in Hong Kong, clearly global investment banks, the bulge-bracket banks, have particular appeal because of their expertise, their global distribution networks, as well as their long-established historical presence in Hong Kong. But due to the firm characteristics of many of these Chinese companies being state-owned enterprises, they also have particular specific preferences as well, because for these state-owned enterprises who list overseas that are being positioned as so-called national champions, there is also a certain preference for Chinese investment banks or securities firms, as they are called in China, due to certain issues about language and communication, familiarity with business cultures in China, as well as certain regulatory requirements on the mainland as well, which does have a preference for engaging Chinese securities firms for these kinds of IPO listings and ECM transactions. So what to bear in mind for Hong Kong is the highly liberalized banking environment with very strong historical presence of global bulge-bracket banks on the one hand, but also distinctive characteristics of Chinese state-owned enterprises with preference for Chinese investment banks or securities firms. Finally, we turn to Singapore, where it is certainly, in terms of equity capital markets and stock exchanges, it is certainly much smaller than Hong Kong. And even in terms of the overall banking environment as well, it is not as highly liberalized compared to Hong Kong. And in fact, the early banking scene in Hong Kong has tended to be dominated by a number of small family-owned firms, and then later on, very large government-owned banks, like DBS, for instance. And it's not until the 1970s and 80s that we see a more substantive entry of investment banks into the Singapore market. But the biggest change really came about during the period called the Singapore Big Bang, around 1999 to 2004, where there was substantive change in banking licensing, which meant that the banking industry became opened up much more to the entry of foreign banks and increased foreign competition. And that led to a wave of consolidation amongst local banks, where with the entry of banks such as Standard Chartered, HSBC, for instance, and Citibank as full banks, so previously they were much more limited in their roles. But when they were able to get full banking licensing, it resulted in a lot of competitive pressures on the local banks, which was actually a deliberate measure by the Singapore government to want to encourage local banks to merge and become bigger. The rationale is that they will then be stronger and have a greater, bigger capital base and stronger regional presence to expand into securities and investment banking activities and to capture more of the growing regional Southeast Asian market as well. I mean, a lot of that, of course, has to do with the fact that Singapore has a very small domestic market. So in order for the local banks to grow, they have to go regional, if not global. And in fact, we also see a significant interest in the Chinese clients in the Chinese market from the banks in Singapore. So the next slide gives you a sense of the size of the different stock exchanges of these three financial centers in Hong Kong, Japan, and Singapore. This is based on market capitalization. So over a period from 2006 to 2016, as you can see, Japan certainly has the largest market in terms of market cap, followed by Hong Kong. And Hong Kong has certainly grown very steadily over this period of time. Japan kind of up and down. Singapore as well have also grown during this period, although obviously it has a much smaller capital market compared to the other two financial centers. But I think something that's also quite interesting to note of these three financial centers in Asia is the nature or the characteristics of foreign versus domestic companies that are listed on these stock exchanges. So over the same period of time, 2006 to 2016, if you look at the proportion of domestic listings and foreign company listings in Hong Kong, Japan, and Singapore, it should be fairly obvious that in Japan is highly dominated by domestic firms. And only a very, very small proportion listed by overseas or foreign firms. Now, Hong Kong is slightly peculiar in that sense because you would see that, yes, on paper, the number of foreign listings is also very, very small, although it has grown towards 2016. But a key reason for that, for this strange distribution, is that mainland Chinese firms, of which there are many that list on Hong Kong Exchange, are listed as domestic firms. So figures like these kind of hide some of that dynamics. Now, Singapore is obviously very different from the other two because it's very heavily reliant on foreign firms listing on its exchange in creating a lot of the volume and vibrancy of the equity capital markets because of its very small domestic market. So these characteristics are something to bear in mind as we go through the results and the findings later on. So just to give some background about the data and the method that we used in trying to create these social network analysis, what we did is we looked at the total volume of equity capital market transactions in the that was captured in the Dealogic database in Japan, Hong Kong, and Singapore for the period of 2013 to 2015. So we took a period of 3 years in order to avoid, let's say, 1 year having a huge listing in one market and therefore skewing some of the results. And we looked at the role of investment banks that are listed as the book runner or the lead manager or the global coordinator. So what we were looking for is some form of coordinator or leadership role in coordinating all these listings that were happening in these three financial centers. And the method that we use is social network analysis, or more specifically, an approach called cohesive blocking, following a method that was developed by Moody and White in a 2003 paper. So in taking social network analysis as our approach, the key idea is the idea of social solidarity, which is measured by the cohesion of a group. So this idea of cohesion refers to how, let's say, if we have a group of 10 actors, and if the group that they form still remains connected after the removal of 3 actors, but then they become disconnected by the time we remove the 4th actor, then they have a level of social solidarity of 4. So of course, the higher this number, the higher is the level of social solidarity. So because the higher, if the more actors you have to remove in order to break these ties, the higher the degree of cohesion, right, that this group has. And what we did in this paper is that a new algorithm was developed to try to visualize, right, these forms of social cohesion and embeddedness as different types of nested squares, which I will show you in a few slides later. So other than showing, right, these different groups in investment banks in different kinds of networks by the degree of cohesion, we also try to measure centrality. So the idea is that, so book runners, for instance, they're normally chosen based on their financial resources, right? The kind of network capabilities they have in trying to obtain new information and their expertise in marketing and distribution. So therefore, a book runner that occupy a more central position in underwriting networks, they should be able to reduce uncertainty around IPO listings. So using these kind of centrality measures, therefore, signal certain kinds of prestige and reputation. And this have very significant implications for the operation and maintenance relationship between underwriters, because they will definitely place themselves or try to place themselves in favorable positions within their information networks in order to increase their chances of being included in a future IPO, or they can benefit from being assigned a bigger portion of an issue and have greater profits. So in terms of degree centrality, in this sense, is the number of relationships that an underwriter has. So higher number of relationships will come along with greater access to information and distribution channels. So relationships and channels to other underwriters, investors, regulators, and other business services firms that are involved in equity issuance. Now, betweenness centrality is another measure that we use to capture, right, the ways in which an underwriter may occupy a bridging position between a pair of other underwriters. So this enables some investment banks to serve as kind of a gatekeeper or an intermediary by sitting in between and connecting other underwriters so that they can be connected within the shortest possible pathways. And in this betweenness measure, we've also weighted them by the size of the deal so that some banks do not seem like they are overly important in terms of betweenness measure if they happen to have a very big deal in one particular year. So we had particular expectations, or you might want to call them hypotheses, as we started doing this analysis. So given the initial observations that we had, right, about the regulatory environments and the local banking history of Japan, Hong Kong, and Singapore, we kind of expect that Japan would exhibit the greatest degree of power concentration, followed by Hong Kong, and then followed by Singapore. In Japan, we expected that given the power and the dominance of the Japanese mega banks, that they should command an overwhelming share of Japanese capital markets with dominant positions in corporate finance. And therefore, the ECM landscape in Japan would probably present opportunities only for the largest bulge bracket firms, because they could at least leverage on their global distribution networks by connecting Japanese clients with international investors. Now, in contrast, Hong Kong being a highly liberal financial center with very little differentiation between local and foreign banks, and their role as a gateway for capitals flowing in and out of China, present significant opportunities for a wide range of financial intermediaries, such as bulge bracket banks, large Hong Kong banks, as well as Chinese securities firms, because they appeal to different types of firms and equity issues. So this will lead to a very much more diverse industry networks. Compared to Hong Kong, we expected Singapore, the ECM networks, to be less diverse and dominated by a small number of bulge bracket banks, as well as regional banks. Regional banks are from Singapore, as well as neighboring Malaysia. So this is due to the very small domestic ECM market, coupled with growing opportunities in the regional Southeast Asian market. So in the following slides, what we found out is that the results do largely align with these expectations, but they also review some other important actors and relationships as well that we didn't initially expect. So let us first turn to look at Japan. I hope you can see these sufficiently. I think this particular figure is still okay because the networks are actually not that dense. So the ECN networks in Japan is actually quite unusual because there are only two levels, right? You only see one core central cluster and networks in the middle, and then another group at the outer edges. And what this shows is a very classic core periphery pattern, which is actually quite rare in real-world social networks. And these kinds of core periphery pattern only occur when there is polarization between one group that controls all flows of information or capital or resources and peripheral actors that are dependent on the core group for access to those resources and flows. And this is precisely what we find in Japan. So in looking more closely then at the nature of many of these ECM deals, the Japanese mega banks tends to be the sole book runner for deals that are oriented towards domestic markets. Global bulge bracket banks would be global coordinator for internationally oriented deals. So this dominant role of Japanese mega banks, unsurprisingly, create very significant barriers for entry for foreign firms. And a lot of that, of course, emerged out of the wave of bank mergers after the Asian financial crisis, with the mergers of many Japanese big banks. And therefore, big Japanese banks command an overwhelming share of the Japanese capital markets. So what we have noted as well is that the number of book runners that we find in Japan are far fewer than in Hong Kong, even though, bearing in mind the bar graphs that we saw earlier, the number of deals in Japan are far higher in Hong Kong, but they're handled by much fewer number of book runners. So therefore, highly concentrated networks in Japan. Now, a very different story in Hong Kong. I hope this network graph doesn't, give you too much of a headache. But what we find really, I think, as is very obvious immediately from this network graph, is that the highly liberalized banking environment in Hong Kong result in a much more diverse, right, and densely and more complicated, more complex sort of industry network structures. So most bulge bracket banks have very long business histories in Hong Kong, and they do feature very prominently in the ECM markets. So compared to Japan, certainly, this industry network is much more diverse and have a greater differentiation. There are many more layers, but the different squares that you see are the different layers in which these different banks are embedded, right, in terms of that measure of social cohesion that I mentioned earlier. But when we start to zoom in to look at the core positions inside the top levels, right, of these industry networks, we see a slightly different picture. So let me show you the innermost layers, right, of these networks. So I think maybe it will help if I try to show you the actual image. Let's see if I can try to zoom out of this. If I do share screen. Okay, let's see. Apologies. Let me try to. There we go. Right. Hopefully, you could see a little bit better in here that these are the core cluster, right, of firms that are in the very top level of these industry networks. And I think what is observable, right, from this inner core of the industry network is that they contain a surprisingly large number of Hong Kong and mainland Chinese firms, alongside the familiar bulge bracket banks that we know of, like Goldman Sachs, Morgan Stanley, Standard Chartered, and so on, JP Morgan. But we also see many Chinese firms that are in very prominent positions, like GF, Guangfa Securities, Everbright, Huatai, Guosen, China Merchants, so on and so forth, Bank of China, Guotai Junan. And they are vital in connecting, I will have to zoom out to a different graph, but these are also vital in connecting a periphery of other book runners as well. So what we found is that the Hong Kong ECM market, as we know, is particularly attractive for mainland Chinese companies in seeking IPOs and secondary listings. So on the one hand, yes, this creates opportunities for global bulge bracket banks because of the international networks for the Chinese corporates wanting to attract a wider range of international investors. But there's also a distinctive preference for Hong Kong or mainland Chinese intermediaries because of, firstly, they charge lower fees compared to the big bulge bracket banks, but also language and communication, familiarity with business cultures in China, and regulatory requirements on the mainland as well. They sometimes have a preference for Hong Kong or mainland Chinese investment banks. So therefore, what we see is that while the very large and complex industry networks and the deep capital markets in Hong Kong does present a lot of opportunities for the global bulge bracket banks, they also appeal to different types of banks, such as large established Hong Kong banks and Chinese security firms, due to the different client base and the characteristics of the equities that are being issued. I seem to have frozen. Just give me a moment to... Okay, let me try to go back in again. Okay, so that's the core group of Hong Kong. And certainly in trying to point to the important role of Hong Kong as well as mainland Chinese securities firms, this is particularly obvious when we look at the weighted betweenness centrality measure. The top 10 firms, in terms of their ability, right, to connect other investment banks in such industry networks, the top 10 firms in Hong Kong are almost all Hong Kong or Chinese investment banks, which signal their more powerful positions in these kinds of ECN networks, with rich information and financial resources and their ability to generate stronger demand and reduce uncertainty around equity issues. So we did expect some of the largest Chinese investment banks to be important in these networks because, of course, a very large volume of ECM activities in Hong Kong are generated by Chinese firms. But the prominence of these mainland Chinese firms and Hong Kong banks have really exceeded our expectations. So in looking forward, as the capital needs of mainland Chinese firms continue to grow with domestic and overseas expansion, this could mean increasingly important roles for overseas and for local and regional banks in Hong Kong's ECM networks, and perhaps even posing a potential challenge to the position of North American and European bulge bracket banks in Hong Kong's financial center. Now let's turn to Singapore, finally. We see clearly a less differentiated financial network in Singapore. Let me try to zoom in again on some of the inner layers. Let's see, Singapore. So as you can see, the number of layers and the network certainly is nowhere as complicated and multi-layered as in Hong Kong. But what we observe at the inner core is, while yes, they do consist of many global bulge bracket banks, and in fact, global bulge bracket banks account for 77% of all ECM deals during this period in terms of deal value. However, if we look at these kinds of networks at the inner core, we find that local and regional banks such as DBS, OCBC, and CIMB, which is RHB as well, and Maybank, these are Malaysian investment banks. They are also significant in the inner block. And we also see this reflected in the betweenness centrality rankings, which I will show you in the previous table. Let's try to go back in there. So if you look at this table again, right, we again see very prominent roles by banks like DBS, CIMB Group, UOB, and RHB, right, of both Malaysian and Singaporean investment banks being very strongly represented. So what we note from this certainly is that the banking liberalization measures in Singapore that took place in the early 2000s, on the one hand, it increased the entry of foreign banks in Singapore with increasing competitive pressures on the local banks, which led to a wave of mergers and acquisitions of local banks like DBS, OCBC, and UOB, which then pushed them, right, give them a bigger capital base to grow into the regional Southeast Asian market. And this does make sense entirely because of the very small domestic ECM market in Singapore. So with the regional opportunities presented by growing economies such as Malaysia, Indonesia, Thailand, Vietnam, India, this aggressive regional expansion certainly has been very characteristic of Singaporean and Malaysian banks. And in fact, through firm interviews, we got to know that many Singaporean and Malaysian banks have been particularly aggressive in hiring, trying to expand in terms of hiring investment bankers into the business operating out of Singapore. And therefore, this central position of local banks in Singapore's ECM networks is important to note, even if they do not dominate the industry in terms of deal value, which is what most studies would normally look at. So in rounding off, in terms of the conclusion from what we could generate from this study, certainly we do know that investment banking is a highly globalized activity, but our findings, we would argue, does challenge to a certain extent the power of bulge-bracket investment banks, particularly from the US and Europe in Asian financial centers. So even though bulge-bracket banks, right, dominate in terms of deal value, particularly for cross-border listings or those targeted international investors, but if we look at network structures, right, in what was shown in the previous figures, they reveal different patterns of centrality and embeddedness that help to explain certain types of power and position of different types of investment banks, particularly from Hong Kong, from Singapore and Malaysia. So what I argue is that these findings point to increasingly powerful roles perhaps for local and regional investment banks in Asia, which might have future implications for the organizational strategies and industry networks of investment banks depending on their global and local business strategies. So perhaps for Japan, what we see is that it is only very selective bulge-bracket banks that may have the capacity to compete against the big Japanese mega banks. In Hong Kong, certainly with bulge-bracket banks and increasingly Chinese security firms playing important roles, there could be a greater scope for a more broad-based investment banking sector. In Singapore, what we see is the very strong role of regional banks, especially state-backed, state-owned banks or state-supported banks in Singapore and Malaysia with strong regional footprint. So perhaps that might signal potential for collaboration between bulge-bracket banks and local banks in the Singapore market. So some of the implications then for perhaps different actors in these financial centers. For regulators or development agencies, for instance, these kind of findings based on network structures will focus more on the position of banks within these industry networks and not only focusing on the firm size or deals in trying to assess, right, the influence or the importance of different types of investment banks in terms of their ability to access information, resources, or form different kinds of partnerships. And we would argue that such an analysis could also be applied to other kinds of advanced business services, such as law firms or accounting firms, which are key business partners of investment banks. And this could help us in trying to understand cities as so-called strategic places in the global economy. So strategic cities, therefore, they are not only sites through which finance and ABS firms perform their roles as global network makers. These cities are also vital nodes where firms have to be in order to tap into the right mix of capital, knowledge, and market networks. So what we then try to extend through our findings is to develop the arguments about the strategicness of cities as different forms of financial centers to different types of investment banks, depending on their local network structures, their historical context, and regional characteristics. And certainly, we would argue that from this kind of work, the value of studying, right, cities and investment banks is not just to focus on relationships between different cities, which a lot of that work has been done in looking at intercity networks, but to look at relationships within financial centers that could help us to reveal insights into the work of investment banks and how they are positioning financial centers as different types of markets. So I do realize that this has probably taken a bit longer than I intended. So thank you very much for your patience. And maybe I'll return you to Igor to facilitate any further questions.
Thank you very much, Professor. It was a really interesting presentation. And now we're open to questions. If someone has questions, can type here in the chat or unmute your microphone and do the question aloud.
Okay.
So I see here Simone has a question. Simone, do you want to make it aloud, or do you want me to read? Right. So Simone typed, thank you very much for the presentation. I'd have one question. Which country do you think has the most resilience IB network? What would happen if one of the central banks failed? Yeah.
Okay. Well, in the measurements of network resilience, right, or network cohesiveness, that's done in this study, we would say that the most resilient network would be in Hong Kong, because firstly, because of its diversity, right, and because of the multi-layered nature of the networks. So if you compare that to Japan, for instance, where the network structures is so highly concentrated and simplistic in that sense, right, we only see two layers really. So if any of the key nodes should fail or should break, then it would affect a far greater, right, degree of other actors in the network. But in a structure that we find in Hong Kong, for instance, even if one actor should be broken off, there are many other possibilities, right? And that makes for a much more cohesive structure in that network. So using that kind of measurement, then amongst the three, the Hong Kong example, right, would be the most resilient in the kind of question that you're asking. And you're asking what would happen if one of the central banks fail. This is a really interesting question because, you know, people often ask about, you know, the strength, right, or the resilience of central banks, particularly with some of the issues that have happened out of the Eurozone financial crisis, and certainly even in the US, there's certainly concerns, right, about how much, right, could the Federal Reserve, you know, kind of maintain certain levels of systemic integrity given the power of many of its bulge-bracket investment banks. But that's one of the kind of interesting dimensions, right, about the relationship between state and firms, or in this case, states and banks, right, in Asia. There's never been the kind of taboo that surrounds the industry in the US, for instance, but to a certain degree, even in Europe, where the idea of, you know, state intervention or state kind of backing, right, of financial institutions is seen as such a taboo, you know, thing to do until we get to something really severe like the 2008 financial crisis. So it would generally be very rare, right, for systemic kind of instability and so on to ever get to a stage where you do have the same degree of banking failures and financial system failures that would threaten, right, the role of central banks to maintain, right, their roles, right, in the Asia context. Certainly, I hope never to be proved wrong, but I see it as one of the really interesting, right, differentiation between state-firm relationships, right, in Asia financial centers compared to elsewhere in the US or in Europe.
This has another question here.
Yeah.
Congratulations about the presentation. I have one general question related to the further change in financial regulation in China. given further capital accounting and financial liberalization in China, would it be beneficial for Shanghai, Guangzhou, or Shenzhen, and it would threat the current position of financial hubs such as Hong Kong and Singapore?
This is a question that we ask a lot to our interviewees as well, especially in Hong Kong and also in mainland China, but also even in Singapore. And I think the really interesting answers came from the ones in Hong Kong. So there is a growing recognition that even at present, right, a lot of the activities in Hong Kong are being driven out of demand for investment banking services, or equity listings and so on, coming out of mainland China. So a lot of the work, a lot of the financial activity in Hong Kong is already heavily dominated by Chinese financial flows and corporate demand. So in fact, it was law firms actually. So sometimes it's really interesting to speak to business partners, right, of investment banks, and not just investment banks themselves. So I've had a couple of law firms who commented to me that they are finding increasingly that that Hong Kong as an international financial center is becoming less an international financial center, but more of a Chinese international financial center, because the flavor and the nature of industry networks and activities have shifted significantly over the last 10 to 15 years. So in time to come, if other financial centers on mainland China itself, right, like Shanghai, or to a certain extent Guangzhou and Shenzhen, were to build up sufficient expertise, regulatory capabilities, but also more importantly, corporate and investor confidence, then there is a lot of doubt being cast on the longer term, right, of what role Hong Kong still has as an international financial center. Certainly at the moment, a lot of it rests on the fact that even in Shanghai, which is seen as kind of the furthest along in terms of actual kind of market depth and diversity and expertise, it still isn't, right, on the same level as Hong Kong. And certainly in Guangzhou and Shenzhen, the expertise is much more niche in very particular types of market activities. But if it comes to a point, right, and people do think that it would take, in the medium or longer term, places like Shanghai and even Beijing to a certain extent will develop the kinds of not only expertise, but most importantly, investor and corporate confidence. Because what you need is the fact that your investors, your corporate clients are confident enough in the regulatory environment, in the business environment, in the financial expertise to want to do business there, to want to operate out of those financial centers. Then it is a little bit more uncertain, much more uncertain for Hong Kong, because at the moment it is so reliant on what is flowing into as well as out of China, that it doesn't seem to be building other bridges for itself. So of course, right now it's great, right? Everybody says nobody's particularly worried because all the banks, law firms, accounting firm, they're doing such great business, right, out of these activities going in and out of China. But in the medium and longer term, it is raising some concerns among some of the investment bankers and law firms that we are speaking to. Singapore is a bit more removed from that. So even though there is a substantive amount of activities that they have come out of China to be listed in Singapore, for instance, particularly for Chinese corporates wanting to enter into Southeast Asian markets. But a lot of the attention and kind of financial activities is in the Southeast Asian region, right? Thailand, Vietnam, Philippines, and so on, and India as the other kind of Asia giant, right? A lot of that is flowing in through Singapore rather than elsewhere. So Singapore kind of tries to position itself kind of more widely in the broader region rather than trying to orient itself towards one giant neighbor, which is what Hong Kong has done. I think there's another question as well from the chat.
Yeah. You want to do it out loud?
Yes, yeah, that could be good.
So thank you. Please, very Can you ask a question?
Or should I just follow what's written on the chat?
Probably she's without microphone, so that's why she.
Oh, right.
Yeah.
Okay, no worries.
Basically, she is asking, I'm quite curious about your idea about the less developed countries investment banking. How about the situation of IB in LDC?
Okay. I mean, this is a very broad question, right, about less developed countries or emerging economies in general. So what I have been looking at is purely in Asia. But if what is happening in different Asian financial centers may be slightly indicative of what's happening in other emerging markets, what generally happens is that at the earlier stage, investment banking activities do tend to be dominated by the large global bulge-bracket banks, because they could bring in with them the kinds of expertise, different ways of coming up with more sophisticated ways of handling products and so on. And also, they have vast networks, right, that could tap into the international networks of investors. So if let's say you are a Vietnamese company, right, that's wanting to raise money through capital markets, or you want to do some bond issue financing, and you want to do it in a substantive volume, it'll be very uncommon for a local bank to be able to do that for you if you want to, tap into a much wider international audience. Because the main reasons, because we must remember that for things like, let's say, IPO listings, it's not just about raising the capital for a company to expand its business. It's also about international recognition and reputation and branding. So if I'm a Vietnamese company, if I manage to hire JP Morgan, right, to be my lead manager in handling an equity issuance, it sends a certain signal to the broader regional markets that I am a company that is worth watching and looking for, and it has further implications as well later on. If I want to negotiate certain terms with my suppliers elsewhere, if I want to enter into a new market, if I want to borrow money from another bank in another region, and expanding into Europe, for instance. So particularly in the earlier stages, I would say for emerging markets or for LDCs, the investment banking scene would tend to be very much driven and dominated by these big bulge-bracket banks or global players, because they have the capital, they have the expertise, and they have the international networks. It's very appealing to potential clients, right, from those regions. But over time, what we have seen, particularly in the case of both in Hong Kong, right, in the case of mainland Chinese securities firms, as well as in Singapore, right, the cases of Singaporean banks and Malaysian banks who are growing as well very rapidly over the last 5 to 8 years, that they too start to grow their own capabilities. They hire investment bankers that used to work, right, in the bulge-bracket banks, right, to get that kind of knowledge transfers and learning and so on. And particularly, at least in the Asia case, I'm less familiar with other places like Latin America, for instance. Many of these local or regional banks have significant government backing, so they can afford to pump in quite a lot of resources into hiring, into expansion, and in that case, try to grow, right, the regional footprint and capabilities that way. And what we have seen, at least right through this study, is that we do see local and regional banks starting to capture an increasing segment of the market, maybe not in terms of volume, right, but in terms of their position in the industry networks, by sitting in between banks, by sitting in between different types of investment banks and linking them in transactions. Because very often, many of these local and regional banks have certain kinds of privileged access to, it could be regulatory authorities, it could be privileged access to certain kinds of localized industry networks or knowledge clusters, and therefore they can mobilize those kinds of resources that way in order to get themselves into, right, a better position in the industry network. So my answer in summary would be that in many of these LDCs or emerging economies, you would generally see right, global bulge-bracket banks as playing a much more important role. And then over time, probably not always, but over time, in some cases, the local and regional banks start to build up the capacity, especially if local corporates start to generate more demand as well.
I think we have space to a last question.
Okay, I have a question very close related with this, which has something to do with the size of this level of financialization and assets in the East Asian market. I mean, how big it is when we compare with North American markets or Eurozone market, you know, or even Latin America, for example.
Yeah. Again, I'm not as familiar with Latin America, but certainly if you compare to the US market, it is still much smaller, right, in Asia, because a lot of the financing demand out of corporates in Asia is still on bank-based financing, meaning they go for commercial banking loans, right? It's still very much a loans-based system. So we have seen a shift towards a growing demand for equity issuance or bonds issuance over the last 2 decades. But this idea of turning, right, from bank-based financing to capital markets financing is still something that is that takes a process, right, for different economies in Asia, because a lot of that, because you must remember, many of these corporates, for instance, in Asia, are family-based businesses, and they've had decades of relationships with a number of these banks and law firms, right, and accounting firms, and there's usually a preference for maintaining these relationships. So, which is also one reason why I say part of the reasons why local and regional investment banks may over time, right, capture more of the market away from bulge-bracket banks, is that as these long-time customers that they have, right, through these family banking relationship, as their corporates, right, get bigger and start to become more suitable or more demanding, right, and create more demand for capital markets financing, they're much more likely to go with the local and regional banks than to immediately go for a Goldman Sachs or go for a Citibank, right? So, so yes, on the one hand, there is still not a huge amount of demand for capital markets financing compared to the much more mature, so to speak, much more mature markets in the US. But we do see this transition, right, over time. But this transition is also what signals opportunities for local and regional banks to try to capitalize, right, on their existing historical networks with many of these family-based firms, or even state-owned enterprises that would traditionally have banked with state-owned banks. And what we see then is this kind of symbiotic relationship, right? As if you take the China case, for example, as Chinese state-owned enterprises get bigger and they are prompted to grow bigger and go overseas as national champions, then they also bring with them, right, the corresponding demand for financial products, for capital and financial advice through existing relationships with former state-owned banks and the state-owned banks themselves, right, whether you're talking about Bank of China and so on, they're also growing and internationalizing very rapidly. So you can kind of see them growing and internationalizing together through this process. Thank you for the interesting question.
Do you have some other question? Anyone has? If not, I think we can finish. Professor Karen, thank you very much. It was a really interesting presentation, and it was a really interesting discussion here. So thank you for your kind acceptance of our invitation.
Thank you for your patience in sitting through, the multiple maps and diagrams.
Amazing. So just to remind everyone, now we have a call for paper open to our Asia regional company. Everyone is welcome to submit your paper on urban and regional studies, mainly related to Asia, but not only. we are open to a broader discussion. And stay tuned to further activities. We will have a webinar series on regional resilience from April to September. The first one will be a webinar with Professor Ron Boschman.
Oh, okay. Great.
We will have some series of webinar series, and please stay tuned. And thank you very much again. Thank you everyone for being here.
Thank you very much, and thank you for the invitation. Yeah. Take care, everyone. See you another time. Bye-bye.
Just a final reminder, our group also has an activity 1 month from now in Washington, D.C. related with the AAG conference. There will be a session about gentrification and another one related with municipal financial fiscal health, which we held 1 day before AAG. So some of us are going to see each other in Washington, D.C.
Oh, I see. Okay, I'll look out for that because I'll be in DC as well in April. So that's good to know. Okay, thank you. Thank you very much.
Bye.
All right. Thank you, Igor. Bye-bye.
Bye.
Bye.
Thank you. Bye-bye.